At 8:42 a.m., a mid-sized manufacturer in Ohio opens an email no one wants to see. It's from their bank. The revolving credit line that kept payroll smooth and inventory stocked is up for renewal at a rate that's more than double last year's. The CFO stares at the screen, then at the production floor through the glass. Across town, a commercial landlord waits for bids on a refinancing that used to take an afternoon. No one bites. A city treasurer 2 states away holds a muni bond sale. The market demands a yield he hasn't seen since he was an intern. None of these people work on Wall Street, but they're about to find out that interest rates don't live on Wall Street. They live in everything. We like to imagine rate shocks as a banking story, charts of yield curves and clips of CNBC. But the next rate shock won't stop at banks, because banks aren't the only lenders anymore, and they're definitely not the only borrowers. Over the last decade, we quietly built a $40 trillion tower of interest-sensitive obligations in the U.S. alone. Mortgages, corporate bonds and loans, small business lines, private credit funds, auto and card balances. Each one priced on the assumption that money would stay cheap, and each one now rolling over into a world where money has a price again. Multiply that across the globe, and you don't just get a story about finance. You get a story about the real economy: jobs, rents, taxes, retirement checks, and the price of a sandwich. Here's the simple engine turning under the hood. When the risk-free rate rises, every cash flow in the future is worth less today. That one change ripples through everything that touches a spreadsheet. It raises the cost of staying alive for companies that borrowed to grow. It lowers the appraised value of buildings whose income was supposed to look steady forever. It makes governments pay more just to exist, crowding out what they can spend on everything else. And it exposes a truth that low rates hid for years. Some business models were never profitable. They were subsidized by cheap debt. The first domino looks like a banker's problem: asset-liability mismatch. When rates jumped, the market value of long-dated bonds fell hard. That's how we got last year's regional bank scare. Perfectly safe securities produced perfectly unsafe losses when customers wanted their money back. But pause the tape here. Banks are only one set of entities holding long assets funded by short money. Money market funds, hedge funds, mortgage REITs, and even pension systems can be exposed to the same trap. Remember the UK's 2022 pension shock? A technical hedge called LDI, designed to reduce risk, suddenly needed collateral as gilt yields spiked. The fix required emergency bond buying by the central bank. That wasn't a bank run. That was a margin call on the retirement system. Now zoom to commercial real estate, where the math is merciless. A downtown office tower that was valued at a 4% cap rate when money was free needs a different price when investors can earn 5% on cash. Meanwhile, refinancing that used to cost 3% now costs 7%, if you can get it. Income down, expenses up, lenders skittish. You don't need the building to be empty. You just need the spreadsheet to stop balancing. The landlord tries to hand the keys back to the lender. The lender doesn't want the building. The losses migrate. If that lender sold the loan into a commercial mortgage bond, those losses migrate again to insurance companies, pension funds, and index funds that never set foot in that city. A rate shock travels faster than an elevator. Corporate America meets the same wall, only with different wallpaper. For a decade, companies issued debt to buy back shares, roll acquisitions, or just pad cash. It seemed rational. Why not borrow at 3% to juice a business that might return 8%? Then the maturity wall moved from the horizon to the calendar. As tranches come due in 2025 to 2027, the interest bill resets. What looked like a boring coupon becomes a survival question. You can either pass the higher cost to customers if they'll pay it, or you can cut, sell, or shrink. At scale, that choice becomes layoffs, price wars, and stalled capex. None of those are bank problems. They're neighborhood problems. Households are feeling it in slow motion and in real time. Slow motion is the 30-year mortgage that priced the last decade of home values. Higher rates freeze sellers and buyers alike, reducing transactions, starving brokers and builders, and trapping families in houses that no longer fit. Real time is the variable stuff, credit cards and small business lines that reprice instantly. When your carrying cost jumps, you don't need to be insolvent to be stressed. You just need to be human. You skip the vacation. You cancel the renovation. You don't hire the extra person. One family's caution is another worker's missing hours. And then there's government. Deficits used to be abstract, a number in a debate. With rates higher, deficits become a line item called interest expense that climbs like a runaway escalator. Every additional dollar of debt compounds into every additional dollar of interest, and before long you're arguing about what to cut, what to tax, or what to inflate away. This is how rate shocks leak into politics. It's also how they come back out of politics as policy, fees, taxes, and temporary surcharges that outlive the crisis that created them. At this point, you might say, fine, rates rose, things got tight, but won't they just fall again and reset the game? Maybe. But even if the nominal rate drops, the psychology already flipped. Lenders now remember what risk feels like. Investors now demand compensation for time, and borrowers now know that refinancing isn't a right. It's a negotiation that alone changes behavior. Cheap money created zombie companies that staggered along paying interest but never the principal. Higher rates don't kill them in a headline, they kill them by denying the next round. Here's where the plot thickens. The credit system is no longer just banks and bonds. It's private credit funds, business development companies, and non-bank lenders who grew up in the shadow of regulation. They're faster, they're creative, they're not backstopped the same way. When a wave of borrowers stumbles, the pain goes where the new lending lives. That's in covenant-light loans packaged into CLOS, in subscription lines at private equity firms, in merchant cash advances to small retailers, in leasing arms that financed fleets of vehicles now worth less than the lease. A rate shock that begins in treasuries ends up at the used car lot. Add one more accelerant: speed. In the old world, bad news spread by phone. Today, it spreads by push notification. A rumor on a Friday morning can become wire transfers by Friday afternoon and a liquidity problem by Friday night. You don't need 1,000 branches to have a bank run. You need 1,000 thumbs, which means resilience is less about having capital in a binder and more about having cash in the account. So what breaks first? The honest answer is the thing that needed perfect conditions. Sometimes that's a category, Class B offices in cities with remote work headwinds. Sometimes it's a structure, funds that promise daily liquidity while owning assets that trade monthly. Sometimes it's a behavior, companies that roll debt habitually and discover habit is not a strategy. But there's a deeper pattern beneath the headlines. Rate shocks expose mismatches between the term of your assets and the term of your funding, between the price you need and the price the market will pay, between the promises you made and the cash you actually generate. When those mismatches stack, systems wobble. If you're looking for a single villain, you'll be disappointed. Low rates were a policy choice. The behaviors they rewarded were a human choice. We pulled tomorrow's growth into yesterday's stock price. We financed comfort with convenience. We told ourselves a story where volatility was a bug to be patched, not a feature of reality. Rate shocks suggest a different story. Money has a cost, time has a value, and leverage is a fair weather friend. But this doesn't end in despair. A rate shock is also a reset. It rewards solvency over storytelling, cash flow over charisma, duration discipline over don't worry about it. When financing tightens, great operators stand out because great operators can fund themselves with the business they run. Healthy projects get built, prices reconnect to incomes. Investors rediscover the difference between yield and risk. It's painful, and it's healthy, often at the same time. Back to our Ohio manufacturer. The CFO calls a meeting and lays out 3 paths. 1. Accept the higher rate and shrink margins. 2. Pass the cost through and risk losing orders. 3. Change the balance sheet, sell non-core assets, lock a fixed rate, stretch payables carefully, and build a cash buffer that doesn't evaporate when the wind shifts. None of those paths is glamorous. All of them are control. Across town, the landlord stops pretending a 2019 appraisal is a 2025 fact, resets the price, and finds a lender who underwrites what the building actually earns. In the muni office, the treasurer staggers maturities and tightens the budget because borrowing long at a fair price beats borrowing short at any price. A rate shock is not the end of the story if you decide to rewrite your chapter. We built a world that assumed money would always be easy. That world is gone. In its place is a more honest one, where capital is scarce again and choice matters. The $40 trillion debt spiral doesn't have to be a doom loop. It can be a map of where pressure will show and where discipline will pay. Banks will feel it first, because they always do. But the real lesson lives beyond banks, in boardrooms, budget offices, and kitchen tables, where the next decisions get made. If you remember one thing, make it this: interest rates aren't numbers on a chart. They're gravity. You can ignore gravity for a while, jump higher, float on leverage, build taller on thin foundations. But gravity never forgets. When it returns, everything that's bolted down survives. Everything that isn't, doesn't. Choose what you bolt down now.